Hello, dear investor. I present you 3 high-quality dividend stocks on discount, which means their dividend yield right now is considerably higher than it has been in the past, which might indicate a nice buying opportunity right now. My name is Thorsten Tiet. It's all about long-term investing here to help you profiting from sustainable capital gains and sustainable growing dividends as well. This is important disclaimer. It's my opinion, it's my assessment. Please do your own research before buying any of these stocks, although they are, in my point of view, quality stocks. So let's go. The first stock is called PSR, Simple and Public Storage. Word by word. Public storage, largest container REIT in the world with a current dividend yield of 4.3%. You can see it here in the dividend turbo. Here is the dividend yield. There was already higher dividend yield here, but only thanks to special dividends related to extraordinary tax gains related to the acquisition of a company called PS Business Parks. If we omit this special dividend, we see that this 4.3% is more than you got in the past, where dividend yield was as low as just about 2%. So we now get double as much than we got at the beginning, spring of 22 last year. So maybe this is a nice buying opportunity. Let's check about the yield or how profitable an investment was in public storage. And to do so, we can here check the evolution of the stock price beginning of this millennium till now, and this was an annual yield you got, total return including dividends of 12.5%. We also can check without, if we want to. The complete yield will be, of course, less than it is here compared to this one. This would be 10.6%. So to make it short, with this stock you beat the market in the long run. And here is a nice indication that with dividends, or that the dividends, they give you a decent boost of the complete return on your investment. So it's a nice dividend stock. You can also see it here in the quality checks. You see growing funds from operations and, of course, adjusted funds from operations as well. And here you see the special dividend again. Anyway, this stock lost some of its glamour in the last months, where the stock price was already as high as here. We have the all-time high of public storage was as high as, come on, $420, and right now the stock is $253, costs $253, which means we have here capital losses compared to all-time high of close to 40%. Why is it so? I think it's a problem of supply and demand. We have a lot of supply. In the last years, there were new container companies growing and making more business. And now we have harder times from the demand side. People don't move so often in the United States. People don't have so much money anymore. And we can see that there is a problem. If you look into the last quarterly report, here you see the tenants canceling their contracts. You see the new tenants replacing these tenants here. They can be replaced, the old tenants. You see it here with the square meters. Rent square meters, it does not change very well, much. It's mostly the same. Lost 84,000, got 84,000. But the price, there's a big difference per square meter. Was $21.40, where they paid the tenants to public storage who left public storage, and new tenants only pay $60.21. And this is a problem, and this shows us that there might be a problem of demand if public storage needs to give such high discounts. Anyway, we have a quality stock. It remains a quality stock. We just need to be aware that it's a little bit cyclical. We also can see it here during the financial crisis that the funds for operations went down from 561 to 472 US dollar. And of course, we also have high interest rates, which is a bad thing in the short term for all dividend stocks. So this is a little bit an anti-cyclical investment, like the other two stocks maybe as well. So let's check out by the valuation. We take the adjusted funds for operation, and I show you here the fair value out of the box, and it is 326 US dollar compared to a stock price of 253 US dollar, indicates a clear undervaluation. What we can do to be a little bit more careful is we can bring the multiple, historical multiple, which is applied or which is used to calculate the fair value, down. We have expected growth rates in the next business years in the middle single-digit rate, which was also the case already, for example, in the years here 2017 to 2019, 2020. Let's check out what was the valuation of the stock there. 2020, 2017, it was above or around 20. So we can lower the multiple to 20 to be a little bit more careful, and then we get an expected yield of 30.9% expected annual yield based on total return, which includes dividends. You can even lower it a little bit more if you want, or use these helper lines to go even lower, because this would indicate a fair value of 344 US dollar end of 26, which is already considerably less than the more than 400 US dollars stock already cost. You can even go down even more, let's say to a fair value of just 305 US dollar, and you still get a double-digit annual expected yield of 10.2%. So in my point of view, this could be a nice stock to invest in. And now comes stock number 2. Number 2 is a symbol GIS. Maybe you know what it is. It is General Mills, producer of cereals, yogurt, snacks, and pet food since some years. This pet food segment was created in 1929, and they expanded it with some acquisitions. So the current dividend yield is 3.4%, and 3.4% is not all-time high dividend yield, but it's more than you got in the past. Still at the end or beginning of May this year, you just got less than 2.5%. Now you get 3.4%. You get close to 1% dividend yield more than about, I'd say, 6, 7, 8 months ago. This is, of course, due to declining stock price. We are here, it's like year to date, and then logarithmic, and then you can see here that 12th of May there was the all-time high reached, and since then the stock price went down, and we have capital losses of 20.7% based on all-time high. Why is it so? I guess General Mills has to fight or has the same problems as other consumer brands. Their input costs rise due to inflation, and what they need to do is increase pricing. And they also increased prices up to 10%, and this worked for the longest time, but right now they are struggling a little bit because management says people are now more and more buying less expensive brands, also outside of General Mills. So General Mills now has to fight a little bit the trend of sluggish demand and that people don't have so much buying power right now. Anyway, it's a good company. You can see it here if you look at the adjusted earnings growth. Dividend growth is not so super dynamic. It's in the low single-digit rate. You see it is between 3 to 4%, somewhere between this. So it's a saturated market already they are in. But anyway, we have here this considerable less expensive stock than it was in the past. This might indicate, also as an anti-cyclical investment, a nice buying opportunity. So let's check this. We have here an historic multiple of 70.2 based on adjusted earnings. And right now it's 50.4, which indicates undervaluation. We have here these growth rates on the same level as dividends and the low to medium single-digit rate, which is above the same we had here in the past, 21, 22, for example, where the stock was valued with multiples. Here you can see it, 21, 22, of about 15. It's the same as we have right now. So I would bring this a little bit down to what the stock market says right now, and then calculate here the expected return, which is 9.6%, which is already more than you can expect from the broad stock market, 9.6%. And this is, I think, at least as much as you got in the past, or even more than you got in the past. In the past, you got 7.5%, so it was in line with the average yield to expect in the stock market somehow. And now you get even a little bit more because the stock seems to be fairly or undervalued right now. So that was the second stock. On the third stock has the symbol G&G, which is Johnson, or stands for Johnson & Johnson. Of course, you know this company. Current dividend yield is 3.1%, and we have here the dividend yield. You see it again, 3.4%, and you see it that it's more than you got here in the last years. In 2015, you also got 3.11% like today, but it's already 8 years ago. Some months ago, dividend yield was as low as 3.4%. So we now got considerably more, and we also have dividend increases. This company increases its dividends in 60 years already, and we have dividend increase a little bit more dynamic than General Mills in the medium single rate, about 6% each year on average. We also have this nice quality here right now. And let's check the performance of this stock, what you got in the long run, like this. And here you got, I want the long run. Long run means beginning of 2000, once more, beginning of 2000, so right now. You had an annual yield of 6.5%, which is a little bit less than General Mills by the way. But you can see it here that at the beginning of 2012, the yield got higher, so even reached 10%. So, what to say for Johnson & Johnson? Please remember, this makes the stock more attractive, at least to me. They got this split off from the consumer segment into a new company called Kenvue. And this consumer segment had no growth at all. You see it here, there was no growth at all. Growth is coming from the pharmaceutical segment. You can see it here very nicely. And this is the new Johnson & Johnson looks like this, without the consumer segment. And this makes it a better company. You can also see it here. Margins shall rise, okay, revenues shall decrease a little bit, but margins shall rise very much, and there will be more growth in the future, or at least I expect more growth in the future than there was in the past. On the other side, we still have these class actions due to this asbestos and baby powder, and this is still a risk to take if you invest this stock. But this is nothing new, so I think we can go to the valuation right now. We use the adjusted earnings, we add the fair value calculated on the adjusted earnings. We zoom in, and when we see here that we have now a fair value for the current business year of $165 based compared to $151 current stock price, which indicates nice undervaluation compared to this, a nice annual yield of also close to 10%. This is the same that you got in the last year since 2012, as we have seen if you invested into this stock. So these were all three stocks, in my point of view, three quality stocks with a higher dividend yield than you got in the past. Let's drop a comment below which of these stocks is your favorite, and you can also mention your own stocks, your own dividend stocks on discount, if you want me to cover any of these in one of the next videos. Okay, thanks for watching. See you next time. Bye bye.